Welcome to the weekly review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week, I will focus on where the S&P 500 is as of weekend November 23rd, 2018. Afterwards, I'll review several sectors and see what they are telling us. Finally, I will try to give some perspective of where we are currently with the S&P 500 and two different times when we were in similar situations, but with two vastly different outcomes. Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Invest involves risk, including loss of principal. Before I get into my outlook, let's go over some items. This week, I'll be using weekly charts. Inside the charts, I will use the candlesticks for the weekly price of the index. Clear and black candlesticks represent a positive week, while the red means a negative week. I will only use the 40-week moving average, which is represented by the black dashed lines. This moving average is used by many traders as a long-term trend indicator, and for those of you who may use daily charts, it is equivalent to the 200-day moving average. Finally, the time frame of this chart is displayed on the bottom of the chart. In it, we will see the S&P 500 index from the week beginning 11/20/2017 until last Friday, the 23rd. Now back to what we're here for. Last week, the S&P 500 saw a decline of 3.70%. The index has now completed its fourth week of being below the 40-week moving average. That is never a good sign, but it does not mean a crash is coming. But it is concerning. This chart we are looking at is the NYSE ARCA Industrial Index. Companies such as General Electric and Honeywell represent this sector. Now, as we can see on this chart, unlike the S&P, this sector began showing weakness in late 2017, finally starting and staying below its 40-week moving average in early February. It has made several attempts to get above this line, but has failed every time. Two things of concern for me of this sector. One, it has yet to fight through and stay above its 40-week moving average. And the second is that long-term moving average is in decline. That shows strong headwinds going against this sector. The next sector I will look at is information technology. I will use the NYSE Information Technology Index. Now, like the industrial sector, this index began showing weakness in late 2017. After a brief rally in January, it began to fall again until hitting a low in late April. After that, there was hope that this may have been an ordinary pullback. But after pushing above its 40-week moving average, another pullback occurred. This time the drawdown broke through the previous low in late April. There are several concerns in this chart. One is the failure of this sector to hold above its 40-week line after it rallied in the summer. Two is a declining 40-week moving average. Here we have the New York Stock Exchange financial sector, with interest rates finally beginning to rise after 8 years of being dormant and regulations scaled down. One may expect a sector that should be doing well. While it has fared better than both the industrial and infotech sectors, it too has not had a stellar year. As we can see on the chart, this sector peaked in January at 373.15. After that, a steady decline ensued. Each rally failed to break the high of the year, which shows there is resistance. Also, we can see, beginning in June, true weakness when it falls below its 40-week line. Like the tech sector, it was able to rally above that line but has since fallen below it. It has now started and stayed below this important indicator for the last 8 weeks. Concerns? Yes. Failed rallies could not let it stay above the 40-week moving average. 2. The long-term moving average is beginning to slope down. The final sector I would like to review this week is the healthcare index, represented by the S&P. Here we will see 2018 started off well for this sector. But like the general US equity markets, it fell back during February and March. After that, we start seeing closing prices moving higher. Until finally, this sector pushes through its 40-week moving average. And the good news, unlike the other sectors or the S&P 500, has stayed above this important indicator. Now, what do I like about this sector? 1, it broke above its old high of the year in late September. 2, though it did show weakness and fell below its long-term moving average, it did something that none of the other sectors demonstrated, or the S&P. That not only can it fall below its moving average, but has the strength to get back above it and stay above it. And finally, with the recent downturn pressure in the US equity markets, this sector has peaked below its 40-week moving average, but not closed below it. In fact, it seems to be using this moving average as a line of support. So this sector, unlike the other sectors, is showing some positive signals. Now let's get back to the chart of the S&P 500. I will now focus on the last 6 weeks where it broke and stayed for the most part below its 40-week moving average. Now, does this signal that we are in the beginning of a major drawdown? Or is it just being pulled back enough to slingshot to a major market rally? Now, the next couple of slides will show you that similar market conditions can result in 2 very dramatic opposite results. Here we have the S&P 500 index. I will cover the index for the time period of November 29, 2007 until the first week of November 2008. I again will use the same indicators, weekly price and the 40-week moving average. I have already boxed in 7 weeks, beginning November 2007 until December 2007, when the S&P began falling and having a hard time getting and staying above this indicator. Not once during this time frame did the S&P open and close on the same week above the 40-week. The end results, beginning in January of 2008, this index stayed below its long-term moving average. Now, even in falling markets, we see rallies. But it does not matter unless they begin to break the downtrend. As you can see, there was an attempt to rally beginning in late March until late May of 2008. The result, the failure to break above a falling 40-week moving average. Price again begins to fall. Also notice, during the rallies, they do get close to the 40-week line before they fail. After failure several times, the market gives up and begins a major crush and fall. Now, here we have the Nasdaq from late March 1998 until the week of April 2nd of 1999. Again, what I want us to focus on is where I box the price of the index. In the box, we see the Nasdaq fall below its 40-week moving average and stay below it for 10 weeks. Now, in hindsight, some may say, but it was a tech bubble. But let's take a ride on a time machine back to August of 1998. The Russian ruble collapsed and sent markets in fear. In the US, there was no hiding the after effects of the currency collapse. One, it was also just barely a year when we experienced the Asian currency crisis. And second, the biggest hedge fund at the time, Long-Term Capital Management, was on the verge of collapse. This hedge fund that was run by former Nobel Prize winners and the old guard of Salomon Brothers was the toast of the town. Many of the major banks put their money in this fund. Now, they bet big on the Russian ruble, and they were wrong. And since they were leveraged to the hilt, when it went wrong, there was no money to cover. There was concern of an epic financial crisis. In fact, the Fed had to oversee the major banks bailing out this hedge fund to avoid contagion. Again, for me, it does not matter the news or the reasons why markets go down or up, but it is for information purposes. And yes, the tech bubble almost did not happen. Now let's get back to the charts. Unlike the S&P in 2007-2008, the Nasdaq was able to fight and break through its 40-week moving average. In fact, to show strength, it broke through the previous high in 2007. And the results from that point on was drunken history. From the low price in the chart of 1357.10, the Nasdaq went on to peak in this bubble at 5,048.62 on March 10th, 2000. What does this all mean? Well, there are two major concerns right now for the S&P. One, its price is below its 40-week moving average. Two, its moving average is beginning to flatten out. I do not want to see it begin to slope down. Why? Because if the S&P 500 fails to break through a fallen 40-week moving average, it will also fail at lower high peaks. Right now, we are in the early stages. We may have to wait several more weeks to get a better indication of where we are headed. Now, the 40-week moving average is not the end-all of indicators. In fact, it is a basic tool that many traders use to give them guidance as to the long-term trend of a market or index. But even as a basic tool, it is a very important tool one can use. There is no need to front run this current market. Let the rallies and the drops for the next several weeks play out. If it can muster a rally, stay above its 40-week line while it is sloping higher, that is great. If it stays below and can't get above a falling line, then at least we know where we are. There is no need to be a hero in a choppy, uncertain market that is below its 40-week moving average. I would like to thank you for viewing this video, and I hope it was helpful. Subscribe to the Hernandez Retirement Services channel on YouTube.